China and its economy, which is making global headlines for reasons that China will not be pleased with. The Chinese economy seems to be witnessing a significant slowdown, with the country registering its second quarter gross domestic product or GDP at 6.3%, much lower than expectations. This marked a 0.8% pace of growth from the first quarter, slower than the 2.2% quarter-on-quarter pace recorded in the first 3 months of the year. Making matters worse, the unemployment rate among young Chinese people between the ages of 16 and 24 was 21.3% in the month of June. That is a new record. Now, in March this year, Beijing set a goal of around 5% growth for 2023. Let's look at China's export numbers from June. These show signs of a weakening economy, and it is confirmed by the trend in the country's Producer Price Index or PPI, which has fallen to minus 5.4%. Retail sales for June rose by 3.1%, a touch below the 3.2% expected. Within retail sales, that of catering, sports and entertainment products, along with alcohol and tobacco, rose the most. Autos, office products and daily use goods saw sales decline in June from a year ago. Online sales of physical goods grew by 6.7% in June from a year ago, slower than in May. There is one silver lining though. Industrial production for June rose by 4.4% from a year ago, better than the 2.7% forecast. Fixed asset investment for the first half of the year rose by 3.8%, better than the 3.5% predicted. But within fixed asset investment, that in real estate fell further on a year-to-date basis in June. Investment in manufacturing grew at a steady pace, while growth in infrastructure investments slowed. In some good news for China, domestic travel has been a bright spot in its economic recovery. Urban residents more than doubled their tourism spending in the first half of the year from a year ago to 1.98 trillion yuan. That's $280 billion, according to the Ministry of Culture and Tourism. However, rural resident spending on travel only rose by about 40% during that time. So what are the primary factors driving China's economic slowdown? China ended its COVID-19 controls in December last year. An initial economic rebound has lost steam. The massive real estate sector has struggled to recover, while exports have plunged due to falling global demand. Within China, lackluster consumer demand has led to no change in prices in June. The People's Bank of China said last week that it expected a dip in July but anticipated inflation would pick up again later this year. The combined first half total of 2.3 trillion yuan was less than the 2.78 trillion yuan reported for the first 6 months of 2019 before the COVID pandemic. Why is China cutting interest rates? Cuts in interest rates are typically undertaken when policymakers are concerned about the growth outlook and want to incentivize economic activity. Lower interest rates make it cheaper and more affordable to take a fresh loan and consume more, that is, buying goods and services such as cars and houses. Last week saw several economists and analysts across the board cut China's growth forecast. This included JP Morgan, UBS, Stanchart and Nomura. All of them trimmed China's growth outlook from being closer to 6% to being closer to 5%. Cutting interest rates sounds strange in recent times since the world over, policymakers have been more bothered about containing inflation by raising interest rates. Most central banks have been aggressively raising interest rates. Therefore, is inflation hurting China like it's hurting the West? Well, China has been in a rather unique position. Unlike the rest of the world, which suffered average inflation rates of 8.7% in 2022 and 7% in the current year, China had witnessed an inflation rate barely touching 2%. As such, its policymakers have not had the worries of containing inflation. Their problem is increasingly about sustaining China's economic growth momentum. Let's take a closer look at the youth unemployment rates in urban areas. Unemployment among those between 16 and 24 years of age has not only been 3 to 4 times the overall unemployment level, it's also rising alarmingly. In May, it clocked almost 21%. That means 1 in 5 Chinese youth is looking for work and failing to get it. This points to the lack of jobs and a substantial slowdown in the underlying economy. What is therefore clear is that China's growth momentum seems to be faltering. Faltering growth rate suggests that underlying demand is weak and businesses are holding back. At 4% growth rate, May saw the lowest growth rate in a year's time. As world trade falters, Chinese policymakers have been trying to transform their economy into one which runs more and more on domestic consumers. India, for example, depends heavily on domestic consumption, and this has been a weakness in recent years. So how does the Indian economy stack up vis-a-vis China's? Firstly, we have to understand that China's annual GDP is around $19.3 trillion. That means each year China produces goods and services with a market value of over $19 trillion. That means if China grows at 5%, which is its official target rate of growth, it will produce an additional GDP of close to $1 trillion. For perspective, India's GDP is around $3.7 trillion. In some ways, the India of today is similar to the China of 2007. As per Moody's, the Indian economy has recently crossed $3.5 trillion in size. The IMF expects it to exceed $3.7 trillion this year. A decade and a half ago, the Chinese economy was of comparable heft. China then had a per capita income of $2,694, while the International Monetary Fund expects India's per capita income to rise from $2,379 in 2022 to $2,601 in 2023. The underlying drivers of growth in the two countries differ. China's meteoric rise has been driven by investments and exports. Between 2003 and 2011, the country's investment to GDP ratio averaged 40%. In comparison, even during this high growth phase, the investment ratio in India averaged only around 33%. Worryingly, the gap between the two countries has widened since. In the years from 2012 to 2021, as the Chinese economy pulled further away, its investment ratio climbed even higher, averaging almost 43%. In India, it fell to around 29% as the investment momentum tapered off. While there are some signs of activity picking up in a few sectors after this almost decade-long slowdown induced by the twin balance sheet problem, how investments fare over the coming years will have a bearing on whether India attains upper middle income status as per the timelines being currently projected. Of course, the United States and China are currently engaged in competitive efforts to decrease their economic interdependence in vital industries. The US is actively pursuing friend-shoring strategies, focusing on critical minerals and the renewable supply chain, particularly in relation to electric vehicle batteries. On the other hand, China is working towards localizing its advanced semiconductor industry and reducing the reliance of its trading partners on the US dollar payments infrastructure. Significantly, foreign investors are cutting back exposure to China. For instance, Canadian pension giant Ontario Teachers' Pension is said to have cut back its positions in China. Global VC giant Sequoia split its China business into a separate entity. Warren Buffett sold over 50% stake in Chinese electric car group BYD. The GIC has slowed the pace of its direct investments in China, and the CDPQ, which manages $300 billion, has stopped making private deals in China and is closing its Shanghai office. China is also falling into a balance sheet recession and needs to ramp up fiscal stimulus quickly to address the challenge. While China is by far the biggest market, whereas India's weight is less than half of China's. The big hope amongst both fund managers and economists betting on India is that as China's share comes down over a period of time, India's share will rise, pushing tens of billions of dollars into the Indian market over the next few years.
The urban surveyed unemployment rate averaged to 5.3%, down by 0.2 percentage points over that of the first quarter. In June, the surveyed unemployment rate in the urban areas was 5.2%, the same as that of the previous month. The surveyed unemployment rate of the population with the local household registration was 5.1%, and that of population with non-local household registration was 5.3%, of which the rate of population with non-local household agriculture household registration stood at 4.9%. Specifically, the surveyed unemployment rates of population aged from 16 to 24 and from 25 to 59 were 21.3% and 4.1% respectively.